Hello, this is Danny Holder with Capital Retirement Planning, and today's video is going to cover a market update. I need to note at the beginning of this video that this is not investment advice. There are no specific recommendations here. This is for education and instructional purposes only, and you should seek the advice of a qualified investment advisor before making any investment decisions. The market has begun a somewhat orderly downward movement over the last several days and several weeks, and we note that especially in our short-term indicators, including the 30-week, the 10-week, and the high-low. All of these have turned to columns of O's, meaning that they are now heading lower, and also our intermediate term indicators such as the New York Stock Exchange bullish percent, which is a measurement of risk in the market, has turned to O's, and more troubling on the New York Stock Exchange bullish percent is the fact that it has reversed down now for a second time from above 70%. Other major indicators that are in O's at this time include the S&P 500 bullish percent and the world bullish percent having gone to O's. Let's take a look now at the S&P 500, and we'll see on this chart that it has been progressing nicely in an uptrend, generally speaking, for the past couple of years, except for this short downturn here. But we can see that the chart of the S&P 500 is beginning to fall off a bit, having produced sell signals at this point and another sell signal at this point. And as we speed up the chart by making the box sizes smaller, we see what is an even more troubling report, in that we have a series of lower highs and higher lows. This formed a triangle pattern. It broke out from the triangle pattern and has since given a couple of sell signals since breaking out of the triangle pattern. You'll notice that today, with the blue X's, the S&P is up just slightly, but overall this is a troubling chart because of the way that it looks, and a big portion of this is from Bernanke's talk last week, when he mentioned that there could be a tapering off of the quantitative easing later this year, and that was enough to send the market going down substantially. But what bothers me at this point is that we had substantial downturn prior to Bernanke's talk, so I don't attribute all of this downturn to the information that we received last week. Taking a look now at the New York Stock Exchange bullish percent, we see that we are in a column of O's, which means the percentage of stocks on the New York Stock Exchange that are on a buy signal is decreasing. And again, the troubling part is that not only is it in a column of O's, meaning the percentage is decreasing, but it has now reversed down from a level above 70% 2 times. And if you look back historically, there are many occasions where it's the second downturn from above 70% that produces a large downturn in the market. And let's look back to 2011 as an example. Here we have a nice uptrend. The percentage of stocks on a buy signal is increasing, and we get a reversal to O's. We get a very short reversal back up into X's, and then the downturn is on in a big way. That's the type of thing that we want to avoid in our investments and not see big downturns. So this could be the beginning of another such downturn. We never know which way the market's going to go, but we need to consider our indicators, know what they're telling us, and act accordingly. So not only is the stock market in a general state of decline, or an early stage of decline if you will, but there's trouble on the fixed income front as well. If we take a look at the 10-year Treasury yield, this index shows us the interest rate on Treasuries currently. We can see that since May, indicated by the 5 here, that interest rates have been increasing. In May they were 1.625. This chart is the interest rate multiplied by 10. So on a 10-year Treasury bond in May they were paying 1.625%. That went up to 2.65%. That's a large increase in interest rates. As you can see, that has come down today nicely, and we hope that it continues, but we don't know which direction it's going to go. What this causes, though, is it causes our bond funds and our bonds to go down in inverse relationship. And I'll show you the chart for the TLT, which is the 20-year Treasury bond fund. As we look at it in May, the per share price of this fund was $124, now having declined to $108 per share. So a lot of folks feel that bonds are a safe and stable place, not having the volatility of stocks, and certainly they don't have the volatility of stocks. However, it is possible to lose money in bonds and see your portfolio decline. And this is going to be a big issue if it continues. For those who have invested in target date funds within their 401k, those funds are comprised of stocks and bonds, and the closer the the target date is to today's date, the higher portion there will be of bonds in that fund. So we could see a significant decline in 401ks if you're invested in those target date funds, because not only are securities or equities decreasing, but fixed income is decreasing as well. And lastly, we've seen in the last week that, except for annuities and money market, there's not been a good place to hide, so to speak. This is the chart on gold. This is an ETF that owns shares of gold. The prices that you see here are for 1/10 of an ounce of gold. So an ounce of gold last October was selling for $174, and it's now per ounce down to $124. The decline since 2011, this is 2011, here's 2012, the decline since 2011 has been about 30%. So on all fronts, we keep our eyes open, we watch what is going on, we take action as appropriate to preserve assets, because it's much harder, takes much longer to earn money back than it does to lose it. It can go down very quickly. So we're going to keep you updated. We're going to keep our eyes on the market and again take actions accordingly. And thank you for watching this video, and I wish you well. Thanks.